Hey guys, what's up? Welcome to another episode with me, Shashank Godappa. And in today's video, I'm going to talk about 5 dividend yielding stocks for 2026. Now, here, what I'm going to do is first, I'm going to explain the concept of dividend yield. I'm going to show you some screeners to identify some good dividend yield. And then we will do a deep dive into some stocks to understand dividend yield as well. So let's not waste any more time. Let's quickly begin. Now, the first things first that we're going to look at, whenever you look at dividend stocks, there are 3 things to look at. Okay. Number 1 is called dividend yield. Number 2 is called dividend yield and index level. And then there is dividend payout ratio, and all of these 3 are very important. Now, dividend yield is nothing but how much annual dividend I'm getting divided by the share price that is there. So if I buy a share for 100 rupees and they give me 2 rupees dividend, in simple terms, I am getting 2% dividend yield. So that is great, right? Now, obviously, if the share price goes from 100 to 200 and I still get 2 rupees, then my dividend yield becomes 1% for that stock. So understand that, right? So ideally, what we want is a company where the share price is also growing, but the dividend amount is also growing to maintain the yield, right? That is what me and you are looking at. So that if the share price goes from 100 to 1000, the dividend should go from 1 rupee to 100 rupees or 1 rupee to 10 rupees or whatever it is, right? So I want those 2 things to pay out. Now, when will such a phenomenon happen? That the stock price is also going up and the dividend amount is also going up to maintain the yield. That is only possible when there is a lot of earnings coming into the company, right? And that also depends on one more factor called dividend payout ratio. Now, the company can earn a lot of money, but what if the company says, you know what, I don't want to give dividend this year. I want to only give 10% of my profits as dividend, right? And dividends is always given at the year-end profits or the quarter-end profits. So if I have 100 rupees, they might say, let's distribute 20 rupees as dividend payout ratio. So that is 20%, which is dividend payout ratio. And the amount of money they keep back with themselves is called dividend retention ratio. So that's how it works, right? So ideally, we want a company that gives very high dividend payout ratio, and we want the company to also grow its money over a long period of time. Now, let me show you another example of, let's say, Reliance Industries, right? Now, if you look at Reliance Industries, over here, you can actually see the dividend yield is 0.45%. So you don't have to calculate it. You can just go here and just search for dividend yield. If you want, you can even do dividend payout ratio. That will also come here, which is 10%. Now, what does this mean? 90% of the profits that Reliance make goes back into Grow Reliance, and 10% of the profits come out here. But if you look at, let's say, another company, okay, let's say ONGC, right? As you see here, the dividend payout ratio is 40%. That means 60% of the money goes back into the company, 40% is given back to the shareholders. And here, if you see, dividend yield is actually 5%, which is more than real estate in our country, right? But the only problem is, does this stock also grow over a period of time? So if you look at the 10-year average CAGR, it has gone up by 4.66, and the average dividend yield is around 5%. So around 9.6%, 9.7% compounded, definitely better than your FD. The only problem that dividend is taxed at your tax slab, same as an FD. Okay, so there's no difference as such. So instead of parking FD, if you have enough time, you can actually do it this way, right? But there is a strategy to play this, and I'll talk about that strategy as well. But first, let's understand this company itself called ONGC, which is oil and natural gas. Now, as I told you, for any company to give you very good dividends, first it has to make money. If it doesn't make money, you will not get dividends. And if you look at ONGC, it is very strong with respect to the payout and the money it makes. The aggregate payout it did was 16,700 crores, and the profit after tax it had made was 49,800 crores. So for me, if I want to take a fresh position in ONGC, and if I go here and I look at 5.5% and take a position, which 99% of retail traders do, they just go check the dividend yield and say, you know what, I will buy it. Boss, you don't know if this will continue or not. What if the company has saturated the profits? What if the profits are going to decline? Then the stock price will also go down. So you will have loss on both sides, right? So that is the problem. So ideally, what I want to see is, boss, is your profits going to grow or is it going to not grow? See, only if the profit grows like this, right? Only then you will make money. But let's say, for example, look at this, right? They had 33,000 crore profit, and then the next time they had only 11,000 crores of profit here. So that year, the dividend payout ratio went up high, but then the next year, it actually fell down to 28% with a lower base. So obviously in 2021, the dividends was actually not very great. And you can see it here, right? If I go here and click on dividends, maybe in 2021, you will see that they had given 1.75, 1.85, 5, and that's it, 5, 6, 7, 8, approximately 8 rupees over here. So that is what we need to look at. In 2020, they only gave 5. In 2019, they gave around 5.5. So this is what I'm saying. Very important to understand, is the stock going to grow? In fact, imagine you buy a stock, which is a dividend paying stock, at its growth phase. that is when you get the maximum benefit. If you buy it at the growth phase, that is when you find a good revenue coming in the future, right? Now, if you look at ONGC, they recently had 3 discoveries in FY26 in the shallow water Mumbai offshore acreage. Actually, I don't know how many of you are from Mumbai, but if you go to the Gateway of India, outside the Taj Hotel, and if you see earlier, there used to be complete beautiful scenery and you could take boat for rent and go. Now you take a boat for rent, you will see so many oil rigs literally on the coastline of Mumbai, right? But this is how it is, and as and when they make more profits, they will give you more and more dividend, right? So first things first, ONGC has a history of giving record profits and record payouts every year, and the finance ministry collection targets keeps the payout coming because most of the money that they get is going back to the finance ministry, and whenever the finance ministry needs more money, they will give they'll give more payout for themselves, right? So that is one thing that is very, very good. Only problem here, as you know, is it's a crude oil and gas linked economy. Windfall taxes, which usually they keep putting whenever they want, when they see a lot of money is coming in, they put windfall taxes, and usually mature fields usually decline over a period of time, and that creates another issue, right? So if you look at ONGC right now, and if you look at the total dividend that they have, so this year they have started with 6 rupees. Last year it was 6 plus 1 plus 5, 6, 9, 10, 11, 12, almost 12 rupees last year. And over time, this also is how dividend compounds over a period of time. So if you look at 2013, they had given only 5 rupees, now they're giving 12 rupees. The dividend only has compounded over a period of time, right? So that is the beauty of this game, and if you understand that game, very good. Another thing is, if you look at dividend yielding stocks, they usually are range bound, okay? So if you see this over a 10-year period, over a max period from 2007, it has been 98 rupees and now it is at 250 rupees. So usually these stocks are range bound. Now, it is always beneficial to wait for these companies to come to their lower end of the range, and that is when you get the best acquisition cost. So at least you're not in loss on the monetary level and your dividend keeps growing over time. And if it by chance falls down, you actually add more money into it and add more units into it. It basically looks at it from that perspective, right? So that is a very interesting concept. Next comes Coal India, which is a Maharatna PSU for largest coal mining. Here they give around 26 rupees to 27 rupees dividend per share. 5.5% again is the dividend yield, and the consolidated PAT is 31,000 crores, right? So if I go and check Coal India here, and please stay tuned, I'm also going to show you a screener, right? You will see that, ignore the P ratio, you will see that the dividend yield is again the same 5.15%, but I would like to always buy at the lower range of the spectrum. As you can see right now, we are in the higher range of the spectrum. So this is not something I would say very likely to be bought at the higher range of the spectrum. Better to buy at the lower range of the spectrum because it's a commodity linked cycle, right? So we don't know how this will play out, but luckily the sales of this company are growing constantly, and the more the PAT and the sales grow, the more money you can actually mint out of this company. And if you look at the dividend that they give, let me go down. Dividend yield is what's important. Dividend amount does not matter. So for this, amount does not matter because the stock price also will be expensive for you to buy, right? But this is how they give basically dividends. So ideally, it's always good if they also do some buybacks, because if they do some buybacks, it becomes very good. So if you look at running yield, that is 5.5%. Consolidated PAT is 31,000 crores, and they have actually grown 12% year on year on the Q4 PAT. But the other two PATs, they were actually negative. They were not that good. It is one of the highest running yield among large cap PSU players, right? It is very good. And another thing that we should also look at when we invest in dividend paying stocks is to ensure that our capital is protected. I have seen many stocks where you buy at 100, it goes to 40, 50 rupees, but it gives you great dividend. We don't want that. So we want the stock to be stable, the revenues to be growing, and my dividend should be growing. And that is what we need to look at from a 10-year cycle. So if I'm investing in 2026, I can't look at the past. Past is too late. We have to look at the future. So I want to understand, will ONGC continue? Will Coal India continue for the next 10 years growing their profits? Maybe the size is too big now that it can't. So maybe that becomes a problem, right? If you look at the key risks, the quarterly swing is very hard, and that also affects your seasonal factors are there, and it also affects your dividend. Energy transition is coming. We're moving away from thermal coal to green energy. So if you look at in the next 10 years, I would love to find a company which is in the green energy giving good, dividends, because then I know for the next 20 years, that can actually give a very good allocation and a very good return on that perspective, right? Third comes ITC. This is a very great company. This gives a mix of both, honestly, and I'll show you why. Let's look at this. So dividend yield is around 5%, 10-year return is around 2%. And if you look at ITC, right, ITC also has been growing quite aggressively over the past few years. But only problem with ITC is in the last 5 years, the growth has been very bad, even though they give almost 100% dividend payout ratio. This is because they have so much money, they don't give two shits about anything, right? If you look at reserves, they have 71,000 crores in reserves. That means their interest income itself is 2,500 crores. They can literally buy companies with 2,500 crores. So if you look at the corporate actions here, they also give quite a good amount of bonuses in the past when they were growing, and dividends obviously keep growing irrespective of the bonus, which is again a massive compounding machine, right? And if you look at ITC, right, in the past it has given multi-bagger returns. From 2005 to 2015-18, it went from almost 30 rupees to 250 rupees along with dividend. It has been a gem of a compounder. But if you look at now recently it has taken a pause because of couple of reasons. One, your cigarette manufacturing and cigarette companies are under the scanner because of GST. Many youngsters are not having cigarettes, they're moving to vape. If you look at ITC with respect to, let's say, the other industries, right, which is the paper industry is not doing well for them as well. The IT industry is the only thing that's actually doing well. So they were talking about demerging this company and they remove the cigarette aside completely. And even if you look at the food and safety right now, it's become very interesting. So that is where they're having a problem. But for a shareholder of ITC, you can't look at this in isolation, because a shareholder would have also got shares of ITC Hotels, which is again a gem of a company, which has actually come back now to its IPO price, as you can see. But this is a long-term gem of a company, and ITC actually makes more money from banquet bookings and hall bookings, which is B2B revenue, rather than hotel room bookings, which is a great thing. All exhibitions are here, and that is something which is amazing. So ITC is one of the best players for a dividend yield, and whenever it goes down is the best time to actually accumulate as much ITC as you can. So if you look at ITC, the total dividend is 14 rupees per share. After the split, 6.5 and then 8 they usually give in the final. Modestly ahead with respect to the previous year. Their dividend yield is around 3.5 to 5%, but right now it's fallen down. And then they did the hotels demerger as well, so that also helped. So basically right now cigarettes still fund everything else, including their growth, and that's where most of the shareholder payout is coming. But even the FMCG has now become a very strong driver of revenue, and that is something that is very interesting as well. They are talking about demerging the business, moving it outside, so that is something as well. And apart from this, ITC also in the middle does like special bonuses, special dividends, right? Suddenly they'll give you 1 year very, very good. So these things are basically becoming very interesting, and if you look at all FMCG companies today, they are actually doing well. Cigarette, as I told you, taxation is coming in, vaping is coming in, so that's creating an issue. FMCG is making lower margins than cigarette. Cigarette is a higher margin business. So now they're trying to see if we can demerge and go into other businesses. Next comes Hindustan Unilever. Now, why am I showing you FMCG companies? They're all sitting at wonderful rates, because all these FMCG companies have corrected so much because they're not very attractive growth. Like if you look at HUL, look at the growth it gave from 2005 to 2022, and then after that now it has been flat, which is accumulation zones, right? Now the flavor of the market is not FMCG, but they are not going to go anywhere because these guys are inflation linked companies. So as and when the inflation grows, they also make a lot of money. And if you look at it in the past, it has always grown slowly only. It has not grown very fast. But if you look at the dividend payout ratio, even they have the same thing. They have too much money problem. They have so much money in the bank. They don't know what to do with this money. So they'll keep going and buying companies, acquiring companies. The only thing is they become a little slow when they start moving. So this has Surf Excel, Lifebuoy, Dove, Lakme, Knorr, all of them are companies from this. And in December, it completed a demerger of its ice cream business called Quality Walls India. Existing HUL shareholders got a 1:1 basis share as well, right? So basically they give most of their money back again. The yield is around 1 to 3%, so it is not very great, but usually their growth is slightly faster. But in the last few years, the growth has been stagnated. It is showing 8.8%, but still 8.8 plus 1.96 is quite better than most of your returns as of now, right? So investment thesis is basically it has a very strong volume in the last 3 quarters. The volume growth has come in, price growth is yet to come in. Right now, they're all having margin issues. I was recently on NDTV with a Marico management call, and they had said that the raw material prices because of crude linked raw material went up. For example, liquid paraffin, HDPE, the bottle caps, the bottle itself, they all became expensive by almost 100% on the raw material side. So that was what the promoter of Marico said when I was on NDTV, but this is basically how it is. And the dividend has also climbed for years and stays well covered. So their payout ratio is good. They make money, and all of this is making a better thing. So I'm only looking at 10 years future. So if you look at everything in today's lens, these are not looking good, but that's a great starting point, right? Because I want to buy things when they're cheap, not when they're very expensive, right? The yield is in the lowest in the portfolio because ITC has a better yield, PSUs have better yield, but this gives a little bit of growth along with the yield as well. Now coming to Power, right? Now this is a company called Power Grid. Again, it's a Maharatna PSU and it is a CERC regulated. This is the company that works very closely with all the power exchanges and all of that as well. And if you look at this company, right, again, 9 rupees dividend yield, 15,000 crores is the PAT. Let's open this and check this out as well, right? Now, if you look at this, you will see that the return over last 10 years is actually 10.4% and the dividend yield is also 3.3. It's almost 13% compounding has happened here. Now, again, don't look at only the past. We'll also look at the future. Dividend payout ratio is at 52% and this is how it has grown. So if you actually see the past, it has not grown at all from 2010 to 2014, 5 years of zero growth, and only now it has grown. So always look at the past and see what is the changing factor. Why is it growing? Is it going to sustain or not? But if you look at India and India's power landscape, I'm very very bullish on India's power landscape. I believe that this will start doing really well. Right now, they don't give a lot of dividend payout, mainly because they need a lot of debt. They're actually a lending company, so they need a lot of debt because they finance most of these players in the market, and they give project-based finance and all of that. So it is very interesting to look at this company as well. But that's where you get power REITs coming into the picture. For example, if you look at a REIT, let's say, like for example, again, I can make a separate video on REITs, but that is IndiGrid. I think IndiGrid. Actually, let me show it to you with a screener. So you can actually go to screener and just put market capitalization greater than 1000, and you can just put dividend yield greater than 2%. If you don't like 2%, you can go a little more aggressive. You can say 4%, and it will show you all the companies here. Then filter it according to highest to lowest dividend yield, and you can ignore Vedanta because Vedanta was an anomaly. It's one-off. But let's say IndiGrid Trust, right? This is what I was saying. This is an InvIT. Now, InvIT again is a special purpose vehicle. I can make a separate video on it. Again, it's like a lot of assets put into one vehicle, and they have to use those assets to generate revenue, and they can keep some portion of it, and the rest they have to give it out to you as a fixed fee, right? And you can look at this. This is actually a lucky InvIT where price appreciation has also happened and dividend appreciation has also happened, and it is in that growth phase, as you can see here, right? And usually what these companies do, they don't do the assets themselves. They go and acquire these assets. That's why you see the reserves are very bad and the debt is very high. They basically go and acquire these assets. Now, to acquire the assets, if they don't have reserves, how will they acquire the assets? So then what happens? They go and do these preferential allotments. They dilute the shares. So these InvITs are basically like units. It's like more and more dilution that happens, right? Then what happens if more dilution happens? If 100 rupees is being given to 100 people, it is great. Everyone gets 1 rupee. But if 100 rupees is given to 1000 people, then you will get 0.1 rupees. But that is how basically it is, right? So they keep going and issuing more and more. And if they do a good job in acquiring good assets, only then the dividend will keep growing. If they do a bad job in acquiring the assets, the dividend will not grow. It is as simple as that. So InvIT and REITs maybe need a separate class on understanding it. I like REITs as well. I think in our Bharat small case, we have the Brookfield REIT, if I'm not wrong. But for example, there is Embassy REIT, right? Again, the way of evaluating this is very complicated, right? I think Shankar Nath had made a very good video on REITs. You can go check it out. But REITs are again very seasonal, very cyclical. So I would say if you really want good appreciation, good growth along with playing the stocks game, it would be better to go play the FMCG place, right? So for example, look at this. If I do this, there is Altius Telecom, there is National Highway, again a REIT, InvIT, Cube Highways, InvIT, Brookfield REIT. HPCL is also very interesting. You can look at HPCL. Wipro, I would not look at it mainly because it doesn't move at all. But HPCO has given 7% compounded plus 6% dividend yield. Not bad. 28% dividend payout ratio. Only problem is it is at the highest part of its cycle. That kind of scares me, HPCL. But yeah, it has done very, very, very well on that front, right? Then you have your basic IOCL, BPCL, all are good. Coal India, ONGC. These are, I think, much better players to play, where you have to forgive growth, but you can play kind of long-term dividend compounding with these. But please note, your dividend is also taxed heavily, so be very careful on that. This can be only used if you want some passive income and passive cash flow and you're not in a very big tax bracket. You can definitely take a equated basket of 5 to 6 stocks. You don't need more, and then you can keep doubling down on those stocks and maybe play like a basket on that, right? Yeah, but basically that is it. These are the 5 payouts by slide, and this is basically what is happening. So I hope you guys enjoyed this video, and I hope you guys like this video. And what I'm going to do is I'm also going to give the link of this PDF or this PPT in the comment section below for you guys to go and read whenever you want. Okay, so again, if you guys watch this video and you like it, please click on the subscribe button because it will really help us grow our channel, because we put a lot of effort into making our content for you guys. Okay, awesome guys, thank you. This is me, Shashank Goduppa, signing off. Take care, see you, bye bye.